Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, January 30th. Mike Boutros here with you this morning. I'm fighting some sort of cold, or I'm hoping it's just a cold, so bear with me, guys. I do apologize if I sound a little congested today. Good to be here with you to cover all these setups right ahead of tonight's. Don't ask me why, but I'm really paying attention to it. For some reason, markets just put a lot more emphasis on this State of the Union address by the president, his first as president, to really set the tone for what the political arena really is to look like heading deeper into 2018. So I'd say, if anything, that's the biggest thing that's on the plate today. Coverage on all the channels starts at 5 o'clock, but the actual speech is released at 9. This comes on the back of a very interesting day in stocks. We're seeing the first material pullback in equity markets since the start of the year. S&P off pretty sharply here to start the day. Futures are showing down about 0.4% still on the S&P. Dow Jones down almost 200 points. So we'll see how this carries out into the session. But for today, what's on the menu? DXY, it's pretty clean. Okay, came into resistance and overnight trade and pulled off again. So we can't really play the pullback just yet. Kiwi dollar. Aussie Kiwi reached a nice level the other day. Dollar yen, pound CAD. Then we'll jump into some of the pound crosses. So pound dollar, for sure, you're seeing a rebound off that level today. Peter Green wanted to take a look at pound Aussie. So I'm going to add that to the mix here as well. And then the Aussie and yen crosses, specifically Aussie dollar and Aussie yen. And then we'll take a look at dollar yen, obviously, before that too. So any other pairs that you guys didn't hear mention or would like to cover, any questions whatsoever, always feel free to throw them on the message board. Eman say, Michael, can we have a quick look or update on the dollar Swiss? Sure. Yeah, I kind of lost focus of that one. I was following it on the intraday page for a couple of days last week. But yeah, we'll take a look at that. No problem. DAX maybe, says Peter Alt. I don't have a chart set on the DAX, but if we have time, Pete, I'm more than happy to take the challenge, man. Always down for some on-the-fly analysis. No worries. Anything else, guys, feel free to throw it on the message board. So let's jump right in. I'll just bring up yesterday's, the Sunday update first, where we went over the dollar levels for the index. So we talked about the dollar index on a weekly basis coming into a very nice little support zone there, 88.26. 2010 high comes in just higher at 88.70. We wicked right into there, saw a little rebound, or you saw it close higher on the week. So to start off this week, that was the level that we were playing off of, right? This is the daily chart. The broader picture still remains weighted to the downside below 91. That's your near-term bearish invalidation level. And I was really interested to see how we start the week. Here's what the intraday chart looked like. The ideal scenario was for us to spike into a low and then find a recovery higher. Where what we did is we pushed a little bit towards 89.55 and we've turned since. So here's what the intraday chart looks like now. I'm still thinking exhaustion on the greenback this week, but I do still think that it could make a new low first, right? So here's 89.55. That was our near-term bearish invalidation level. Price held below that yesterday. Outside reversal candle here early this morning in European trade. Please reverse this right underneath. And now we're testing the objective weekly open and the weekly opening range lows. So any way you slice it, a move lower from here in the index, you're right back on track to 88.71 and 88.27. Okay. A topside breach, you're likely to see that run right into the parallel. And by the way, this is, one of those setups where it's just clean, guys. This is basic trendline resistance, a parallel off the low. Saw a little messy there, but 3-point touch nonetheless. A parallel off these lows, sees 1 touch, 2 touch, 3 touch. Again, a little messy, but we've continued to hold that range. So 90.11 on the upside if we push below the monthly or the weekly open, which we're doing right now. And my favorite move at this point is to see that drop lower towards 88.70, towards 88.27. Now, with the major event risk over the next 48 hours or 24 hours, actually say true 48 hours, right? Because you have the State of the Union address today with President Trump. Then tomorrow, guys, we get the FOMC interest rate decision. Interestingly enough, as we usually do before these central rate decisions, we get proprietary research from affiliate company of ours called Prattle, which gauges market commentary. I'm just going to read you their notes ahead of the ECB's or ahead of the Fed's release tomorrow. So bear with me real quick. It says the FOMC is likely to hold rates and issue a hawkish statement. That's their forecast. The analysis says that the Fed is likely to hold rates at Janet Yellen's final FOMC meeting this week. However, the FOMC statement promises to be fairly hawkish, suggesting Jerome Powell may hike rates at his first meeting as chair. Economic conditions remain strong with the labor market continuing to improve and inflation slowly rising, though the U.S. dollar volatility could be the root cause for some of the commodity spikes seen lately. Last week, overwhelming confirmation vote in favor of Jerome Powell suggests that the U.S. Senate is comfortable with the current plan for gradual hikes. But recent dispersion scores, which is how they rate central bank rhetoric from Fed policymakers, suggest that Powell may have to work on building consensus internally. Nevertheless, Fed sentiment is trending somewhat hawkish, suggests that this week's FOMC statement will sound hawkish, priming markets for a possible rate hike in March. And again, March is going to be Powell's first as chair. So certainly coming in swinging if he hikes rates on his first go at things. But that's sort of the research that we've been working with as far as what to expect. Again, they're not expected to hike rates, but it's really going to be what the tone is that Janet Yellen leaves. And it's likely to be a more of a resilient, on steady as she goes type of tone. Although, at least from the research we've been reading, it does suggest that we should be expecting a little bit more of a hawkish tilt on things, because markets are still only pricing in 2 to 3 hikes, and the possibility for 4 is still there. All right, so major event risk for the greenback over the next 24 hours. Any questions on the dollar? Where we stand, levels, anything like that? Base case scenario is that you still see some sort of drop into this zone, okay? But, we want to be very tempered on a drop into that, because you're starting to come at some really critical levels here. Okay, so where does that put us on the majors? Let's go to yesterday's update. And we'll start off with the Kiwi dollar, which is what I was really focused on. Obviously, for the swing side of things, we just missed the limit on this one, on this drop. But, the major focus for this one was, again, 7 weeks up. We talked about this. Last couple of instances that we've seen that have just been but near-term corrections or near-term pauses before continuation higher. So you could get a 75.16 clip still this month. But the major focus is just that risk at the highs that we made last week. Bear with me. Looks like my mouse just died. There you go. So again, the daily chart had us coming up against structural resistance, and the upper median line parallel with the 786 retracement. You saw real strong wick action into there. 73.07 was a level that we've been watching for a while. We're just looking for that break to get us a basic drop into that 618 again. Decent pivot in price, 72.61. On the near-term charts, we also highlighted the 4-hour reversal close from the monthly opening range highs. The initial monthly opening range highs right there at 72.72. So basically, we gave itself a 12 pip range that we were looking for a drop in. This thing turned literally right ahead. All right, so here's Kiwi now. The low that we registered in overnight trade was 72.79. Again, my butter spot was 72.72 to 72.61. Jamie had the limit at 72.70. It's not all hope is lost, but I'll tell you right now, if we make it through the weekly opening range high, you're probably going to see a 74 clip again. So for anyone who's thinking about repositioning for this, just keep that in mind. So on its face, it's simply a weekly opening range. Here's your weekly opening range high. Here's your weekly low on a Monday, Tuesday stretch. Look for a break of that range. 74 is still the resistance barrier you would need to get to get any type of upside momentum here. But for me, the interesting tidbit about this is the cross that we've been following on Aussie Kiwi. And that's the only thing I've actually been a little bit more interested in playing right now. Just because the dollar has been It's been a crapshoot at best. We'll have to see how this next 48 hours pans out. But DXY risk for moving down. Traders will position themselves according to tomorrow's FOMC hawkish expectations. How can we trade that, Michael? So, Eman, the hawkish expectations, that's proprietary research that we're suggesting. I don't think everyone's necessarily calling for hawkish research or hawkish stance. Based on, again, the research that me and Jamie follow and Prattle, the commentary that's been coming out, it seems that they have to do a little bit more prepping. Look, if Powell's going to come in and stick to the game plan, then yeah, they basically need to start next month, right? And not February, as in March. And that would be his first meeting. So what the argument that's being made is, well, if he's going to come in on his first meeting and hike rates, they basically need to disseminate that information with a hawkish tilt today. So what does that mean, Eman? It's the same exact thing that we came into the week saying. You're starting the US dollar coming just above support. And that being said, if we get a hawkish tilt, okay, to the release, I would be looking to fade a low into 88. That doesn't mean that markets still can't dump into 88 or 88.27 before turning higher. The same game plan for the start of the week, guys. We're looking for signs of a near-term exhaustion low. At least I am on the personal basis for near-term exhaustion low to rebound. Again, the longer-term picture still remains bearish. Remember the analog we've been working with. But at this point, how to play it, Eman, is I'm looking for the market to give us an irrational reaction lower that could offer some sort of near-term bounce. Does that make sense? And again, the FOMC is always a different animal, Eman, than trying to play non-farm payrolls, which is on Friday, right? Non-farm payrolls, you get the release, it comes out, you know it's better or worse than expected, and you look for the market reaction. This is a little bit different because the devil is in the actual commentary of the policy statement. So it takes you a couple of minutes for the markets to sort of filter in to digest what the Fed is saying. That being said, based on what price action is saying, I don't care. All I know is that there is a risk tonight with the State of the Union and tomorrow, right? So based on that, knowing that those upcoming event risks are on tap and what price action's doing, I'd be more interested in seeing this thing lower and then trying to fade some sort of exhaustion low near 188. Again, like I said, if we break 89.55, 90 would be a target near term, but this is the near-term level, or excuse me, this is the near-term level at 91 that would change the broader opinion, heading into February. All things held constant, we're just approaching downslope support. I still think you can get another go at it. Okay, she says, yes, thank you. You're more than welcome, man. Good question. Oh, guys, excuse me one sec. Okay. So, and that is Kiwi. So that's Kiwi and DXY, 1 and 2. Number 3, Aussie Kiwi. And this is the one that I'm more in favor of right now. So we presented this setup early in the month. On the 24th, we were talking about the possibility for a breakout, and that was based on the fact that basically the weekly charts and the daily charts were coiled up in such a manner where it was going to be a basic yearly, or basically monthly at this point, you could say yearly as well, but opening range break if we cleared 110.66. And that target would have put basically 111.86 on tap as sort of the initial level to get to. So there's room to the upside, in my humble opinion. It's just that yesterday we took out the first initial target. So we had 110 and 110.66 or 110.69 as the levels to get as in the upside. Even within the confines of the broader picture for the daily chart, that's the top of the range. You had a 50% retracement there. And again, on near term, you had basic 50 line for the current operative slope. And this is the reason why 110 was going to be our line in the sand. So the break to the upside, we took out that first target. For me, things looked a little precarious yesterday because momentum was unable to make it above 70. You're seeing slight divergence. And you came into a very nice confluence region. Not to mention, this is the yearly high. So objectively, if price max is 110.69, you're right on target for the next subsequent levels, 111.12 into 111.20. is a nice Fibonacci confluence. Then right around 111.40s would be the upper parallel. But the risk for me, initially first was for a pullback, either into former median line support. So the median line for the current pitchfork would be an interesting area for possible entries. But, I want to stay constructive above 110, basically the breakout level of which this thing maxed out last week. So here's what Aussie Kiwi looks like now. Christopher says, can they, Trump and Mnuchin, let U.S. dollar much lower without undermining the tax cut bill by hurting money that just repatriates if depreciates right after it comes over? So, Chris, you're treading into very political waters here. One thing that you always want to keep in mind is, to a degree, what you're saying is right, that it's not going to be quite the effect if you get all this repatriation of funds, but then all of a sudden the funds come in and you're inherently losing value on the dollar, right? But Chris, what you do need to understand, and sort of the unwritten tell here, which anyone who knows economics, anyone who's been in this game long enough knows that near term, Christopher, a weaker US dollar is going to benefit the administration for all intents and purposes. Okay, it makes domestic exports, much more viable and much more attractive to foreign competitors. And in general, it's seen as an easing. Why do you think Japan has been working so hard in the yen and all this, and even Swissy, when it was rocketing, all this intervention to keep their currency lower, is because it is a natural form of easing for the central bank. So it's very important, Chris, to get that one little, tidbit. Obviously, Mnuchin is going to come out and he's going to say, no, we want a strong dollar. Strong policy is, the policy for the U.S. And that's just good for the masses, as a nice little headline. But at the end of the day, for the metrics, the economics of it, in the near term, weakness will actually be a sort of a tailwind to the market. Now, that only comes to a certain extent, right, Chris? And one of the main things that you'll hear every central bank talk about is it's not so much whether we're moving higher or lower, but it's the magnitude or the speed of which the depreciation is happening. That's what starts to become a real concern. Does that answer your question? I think I went on a tangent, but good question, Chris. But we have to always get it that it's going to be helpful. It's going to be supportive in the near term for a tailwind for the markets. To a degree, yeah, they're not going to want to, they're not going to really want that to be something that's sort of running out of control. But if we do start to get, a little bit more of a pickup in inflation, we have Fed moving higher on interest rates, I don't think that it's a major viewpoint that the dollar is going to collapse into oblivion, right? And although it has been a sizable move for sure, I don't think we're reaching that panic mode yet where any central bank is necessarily going to be acting based on just pure dollar metrics. So good question. I hope that offers a little color. So for Aussie Kiwi, from here, okay, here's what we look like now. Again, here's what we looked like last night. So we did get the pullback. We didn't quite make it to the median line, which again, for me, is sort of super frustrating, but I think you still have the opportunity as we head into the U.S. markets, okay? So if we get the pullback lower, I'm still looking for like 110.10 or 110.15, I think, is where the median line would be at first. I'd take a little off the table right there. If we break below 110.10, I think it's a bigger correction, but we have to keep in mind that the broader picture for Aussie Kiwi is a breakout, and that's what we've been playing. This is just a pullback. Christopher says, thank you. Hey, you're more than welcome. This is just a pullback. So again, a basic pitchfork that we've been working with, parallel of that same slope caught 1 touch, 2 touch, 3 touch, 4 touch, 5 touch. There's the breach. The upper parallel, I was hoping to see initial support there, but again, target for me, at least on the pullback, was this median line. So if we get into that median line, I'm out, okay? If it breaks lower, we could possibly look for re-entry, but I really wouldn't get too excited on it. I think even if it gets down into this slider, this sliding parallel, I think that might still be an opportunity to get long. Also, once we finally clear the weekly opening range lows, here's the weekly opening range low. Here's your weekly open, right? Once we actually clear that, a basic retracement of the near-term advance may also offer some levels of interest. I should probably put that right off the low there. And if we do that, you'd be looking for basically targets at 109.85, and then the 50 line, which you saw a perfect rebound there, actually coincides right on the 50% retracement. So 109.58. That's in the scenario of a breakdown. First things first, I just want to see a tag of this trend line. Honestly, I'm out there if it happens. If it does, great. If it does hold rather, and we see another rebound higher, I wouldn't go chasing per se, because this is, again, your yearly objective opening range high, and we failed to get through that yesterday. So, watch for a real concerted effort break above 110.67, and then you have clear-cut targets on the upside, 111.20, 111.13, and then again, 111.40s is where the slope starts to come in on the upper parallel. Does that make sense? So right now I'm just seeing if we can get this slide a little bit lower. Again, if the U.S. market still holds that low, basically, this is Friday's close, by the way. Let me just bring that up. This is Friday's close, basically where we're stopping right now. The weekly opening range comes in, just ticks higher at 110.18, 110.15. So the immediate focus is on this break right here. I just don't have a decent wave structure on this. But if this is to pan out, and you heard yesterday in Jamie's update, guys, we were talking about the divergences that we're seeing with the new highs that were accelerated in Kiwi and not reflected in Aussie, and that divergence can sometimes be a tell of near-term highs. So I think for the Aussie Kiwi setup, if the Kiwi remains resilient as it has, if we get that decent pullback in Aussie, I think this could get us another opportunity to get back in. Eventually on the long side. Right now, I still think you got a little pull lower. Any questions on Aussie Key? Okay, that is number 4. Number 5, dollar yen. Still looking lower. So we were talking about this yesterday. We've been following this one for a time, and the levels are just completely the same and unchanged. We were looking at this nice pitchfork formation, which held for the majority of December and January. The downside break last week, if you recall, we had 109.55 as the level that we wanted to stay below. That was near-term bearish invalidation. We came right into it last week, late in the week. We failed again on Friday right there and failed and moved lower. So as we came into the start of this week, I still think you can get another pop higher, and I'd be looking to fade a rally into this 109.55 level. I know that Jamie had a limit yesterday, I think limit order for you guys at 109.40. It just didn't have enough juice. And it looks like we might be sidelined again on the abomination. Here's what dollar yen looks like. We teetered out like 109.20. Just looking for another tag of that level, couldn't get it. Here's the breakdown. Weekly opening range is perfectly intact at this point. Monday, Tuesday stretched, has made a high. Okay. Tested that high, and here we are testing the low again. So downside break, the levels are unchanged completely from last week. So a soft target at 108.16, that wouldn't necessarily jump out, but I'd take something off there. But the real major targets are 107.86 and 107.50. 107.83 is the 2017 low day close. And then you have a Fibonacci confluence down at 107.45. Also coincides with the early low that we made last year, or the late year high we made in 2016, July there. Pretty damn close. Okay. Work with this level, guys, as far as the slope is concerned. So I'd kind of bring that down to basically where the opening range highs are for the week at this point. And we'll work with that as resistance along that slope. At the end of the day, the bearish invalidation level, in my humble opinion, doesn't change. It's got to be a 110.20 break. If 110.20 breaks on the upside, that changes the broader picture for dollar yen at this level. Okay, but as it stands right now, still looking for that risk for that drop near 107.86, 83. Excuse me, I keep saying 86, and 107.50. Any questions on dollar yen? Oh, the abomination with a slow dribble. Let's see if we can't get some play on this. Okay, last but not least from yesterday is pound CAD. Another one where, last week when we had looked at pound CAD, the one thing that we were highlighting, I'm just going to I'm going to remind you, is that we were talking about that this thing was on the 11th day of consecutive advances. The last time we saw that, we saw a brief interruption before continuing higher towards the upper parallel. Well, this thing came into 74.32 last week. We talked about that. It held for 4 days or 3 days. We did finally break higher, and we just rode this upper parallel for a while before collapsing lower. What we identified yesterday was a break of channel support. So here's what it looked like last night. Okay, we broke through that level, surged right into the upper parallel. We rode it for a good couple of days. Big reversal turnaround last week. Okay, and here's what when we opened the week. I was going to highlight this on Sunday, but I didn't really know what to do there. We couldn't just jump into a short. There was nowhere to put a stop with a reasonable target. The limit was 173, and it literally played out perfectly. But at the end of the day, this thing broke right into a 38.2 retracement of the advance. And for me, I'm still looking for a possible rebound to try to short again. Long term, I still think pound is going to do well. I guess this is going to hint back into Peter's question on pound Oz, which I'll get to in a moment. But I still think long term, you want to be on the upside of this. From here, though, you're basically trying to gauge whether the correction pattern is done. So here's what pound CAD looks like now. Righto. So, boom. I mean, we actually went an overnight trade and tagged it again, a perfect extension of the 173.05 level for the second time before rebounding higher. You're still looking lower below 74.90, which is the high day close, the high day reversal close, mind you, for the pair for this year. So I'd stay bearish below that, but near term, 74.30 and 74.90 are still possible on the clip higher here. Both areas of interest for possible reentry for ultimately a move lower towards the 72 handle. So that's how I'm trying to play this one. Obviously, guys, I would love to see some slope. So as soon as you get these turns, these breaks of support within the confines of a technical upslope, you want to try to find some sort of guidance as far as what price action is doing in the near term in slope. And I just haven't found one yet to my liking that has been sort of encouraging to actually start to operate on this. I was looking at something maybe like that because just one touch, two touch, kind of run through would suggest again that you'd basically want to stay bearish below the high day close 74.96 near term, ultimately for that last stretch lower towards 72. I don't know if we get it, but for me, I'll be looking for an exhaustion stretch up into this region. Questions on pound CAD. Now, your question, Pete, was on pound Aussie, which, if I'm not mistaken, I do believe we've been covering here on the intraday charts as well. When's the last time we talked about pound Oz? Oh, it was right here. Right. So this one okay, I remember this. So last week we were very cautionary, right? That, this is a good spot essentially to take some profits, bring your stops to break even, because we were coming into confluence resistance, the 618 retracement of the decline off the highs and basic slope resistance. It just so happened that we rode this slope for a couple of more days before it turned over. We never quite made it into the upper parallel, into the 764 at 77.80, but it turned right ahead, right, and turned lower. And we've since broken channel support, if I'm not mistaken, pound Oz. Pound Oz. Yes. Okay. So here's it's the same setup. Peter, excuse me. Oh, my voice is not going to make it through the week at this pace. So here's the same setup, right? We turned right ahead of. There's the 618. We probed through it. We probed through it again. We never got into the 786 near the 78. Handle. We actually had the 764 as a target back then, but we never even made it that high. And then here's the turn and break lower. So very similar setup in that we started the week right below channel support. And for me, it kind of just looked too clean on both of these. It freaked me out a little bit. This was right here. What am I just going to short into the weekly open? That's pound CAD, pound Oz, same exact thing. We open the week, rallies right into near-term resistance, 38.2 retracement, former slope support. Here's the pull lower. And again, all we've done is make a very well-defined weekly opening range. Okay, the only thing that would put me back on the constructive tap here would be a conservative break above 175.47. What concerns me on this, Chris, or this was for Peter, right? Peter, what concerns me on this is the wave count. Because if you look at this objectively, to me, this looks like a 1, 2, extended 3, 4, 5, which means you should be looking for a possible three-wave correction. That's why I had, obviously, I guess from last week, a level up here targeted. So I'd still be using any next near-term rally as more of a correctionary exhaust play for the dominant move lower again. But broader terms, this is a breakout trade, okay? And for me, I'm looking for one last low, but you generally want to be bullish on this trade, right? We talked about this since the start of the year. This thing was in a range. What bothers me with this, Peter, again, is that the break of the monthly opening range gave us the late month high. There's the 25th. We came into a new high, and now we've taken back all those gains. Essentially, here's the monthly and yearly open. We're not that much higher. So, is this just a break, a pullback of that same level of resistance again, and then we continue? Or is there one last low to complete a correction pattern, and then we're off to the races again? So for me, that's why I haven't given up down pound Oz. Near term, I think pound can pull back and Aussie can pull back. This is why I get a little hesitant about trying to play pound Oz. Peter, does that make sense? When price is in an uptrend or downtrend, why do you stress the idea that we need to break down or up for suggesting to resume its uptrend or downtrend? Is this goes with what the correction move, Michael? Thank you a lot. Peter says, thanks, that helps a lot. E-Man, I'm not really sure what your question is. Let me read that again. Okay, E-Man, I think I get where your question is. So that's the whole point of the multi-time frame analysis look, right? What we do is we start off with the weekly chart. We have a broader picture of what the trend is, but there are different magnitudes, degrees of trend, right? We have our weekly charts that give us the broader, ultimate, longer-term trend. I use the daily charts for more of a medium-term type of gauge, but within these trends, you'll have smaller trends. And that's why we look when the market is in. Let's look at a live example. You know what? Here's what's the next one up on tap? Let's do pound. I think I know what you're asking, but I just want to make sure I'm addressing the right question. So here's pound dollar, right? We've been wildly bullish the pound. We've gotten, or at least I have, still at Daily FX from the analysts there. I was catching a lot of heat from everyone because they all thought Brexit was going to be the end all disaster. Look, this thing was in a bullish pattern all year last year. I don't care. Even when it was falling off the edge of a cliff here, we were still constructive above 130.36. That sat there for over a month and a half, and it ended up being a very important low. So this is an uptrend, right, E-Man? Within the confines of this uptrend, though, when we come into resistance, there's going to be opportunities to play the downside. So we'll plot a downside trend, and then we'll need to see a break of the downside trend to mark resumption of the broader trend. That's what I mean by, wait for the break. An example of this is the weekly chart. Take it into a daily chart, right? Here's the same focus, right? There was that spike into the highs. But I don't know that this is a high, E-Man. I have no clue, right? It could pull back, and then tomorrow could rocket right through and see a tag of this upper parallel. I don't know. So before I start to advocate that you guys start to take shorts, I need to see a break of a near-term uptrend. That's how it works. So I'll look in price action for something closer in time that'll give me that break. Enter the intraday chart, okay? And certainly for us, there's two ways you could have played this. A, with a rejection of the near-term upslope. So even within the confines of this upslope, any type of short exposure that you had there, whether it was based on the divergence, whether it was based on the trigger break, whether it's based on either of those, you're only targeting this downside channel. That's it. Once this channel breaks, then we have the confirmation to play the downside. And for me, 140.23, and you guys know I talked yesterday about 139.43. That was the last target, and that's really the bullish invalidation for me. I want to see price hold above that. Now we turned to head it. We didn't get quite that low. You don't want to be super sticky with these guys. Markets don't work in a vacuum, but certainly that level was a big level. Basic channel resistance, former channel support. Get rid of this consolidation just to clean things up. But basic channel support, basic channel resistance, you'd want to see that stay there. You want to see a hold above that. Now, I still think, let me take this back. We're not out of the woods yet. I guess that's what I want to say. Let me just snap this this median line here. I just need to get more price. There we go. I knew something was off. Okay. Lost my train of thought. Sorry about that. Iman, so yeah, I was going to say, for me to dispel, okay, and continue to favor resumption of the uptrend, right? So we're in a broader uptrend. We're in an embedded ascending channel. For me to favor, again, getting on the long side, I would need to clear that former channel support, now resistance. So even if this were to rebound up into this region again, you'd still be just break of support, checking it as resistance and moving lower. It's a little different interpretation than the one that Jamie's working with right now. But that's basically what I'm looking at with the pound. The targets for the short, at least, the initial pullback that we were looking for late last week was here and here. Now that we've made this reversal candle off that and turned ahead of it, I'm not going to really fight this at this point. If we get higher towards the upper parallel, again, trying to take stab highs against Friday's high might be a good way to play the short side. But you're basically just set a weekly opening range. You're unchanged on the week, essentially. This is basically where we opened. Here's your weekly open, guys. So you're testing weekly open resistance right now as we speak. In yesterday's webinar, sterling dollar, we're stressing the possibility of going to 133.60 to suggest that we have a more basic high in place, a more important high in place. So if we were to break below 39.43, that would be the level of which, okay, Iman, by the way, are you talking about the update that we put out on Daily FX? Where'd you see 33.60? Because it depends what time frame you're looking at. It might be a weekly chart that we put on there that just gives people a broader picture. And even if this thing, by the way, even if this thing were to drop into 133.36, it would still be, or 133.60, excuse me, Iman, it would still be in the confines of the bullish formation, even in that kind of move. So when I'm looking at those charts, so she says, yes, it's on the weekly chart. Okay, I know exactly what you're talking about. So when we're looking at those charts, Iman, it's very important. I'm mapping this out. This is long term, right? A lot can happen within this 1,000 pip range, but I give people the broader picture of what is the basics. Bottom line. Bottom line, this thing's constructed well within this formation. So even if it were to tank into the 33 handle, I would even say, maybe not 33 handle, but maybe this 35 handle, it would still be within the confines of the uptrend. So that's what would need it to be to suggest that a really important high for the year is in place, because you got a multi-year formation that broke to the downside. That would that would be real technical damage, Eman, to the trade. Does that make sense? I'm glad I was able to visualize what you were talking about there because I was really confused. But that's the basis. So always keep your mind, always keep your eye on the duration and the type of analysis that we're looking at, right? When we're looking at this weekly chart specifically for daily FX, I have to put stuff that's a little bit more evergreen, man. That'll get them clicks and all that. So, give the longer term view. This is where we get into the nitty gritty. But near term 39.50s really would be a sweet spot for support. Top side 45.71. That's a big level. Former swing lows, 50% retrace of the entire 2014 decline, the upper median line parallel, you name it. Okay, so that is pound dollar. Number 6, that's number 7. Number 8. Or we did pound Oz, right? We did pound Oz for Pete. Aussie yen. So Aussie yen is a trade that we've also been following. Everything has been so touch and go. It breaks down lower, tags your level, then comes right back, right? So here's what Aussie yen looked like earlier in the week at the open, or I guess this was last week. And the weekly chart had a very basic and objective key range between 87.60s, I can't see it there, and 89.11. Just a basic opening range for the month. We were going back and forth ping pong, right? Here's what Aussie yen looks like on the intraday chart or on the weekly charts. Boom, 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 right? Nice confluence region there. 2016 open, 50% retrace from the decline off the 2014 highs. This is your simple high week close for last year. It's 89.11. And we're just simply looking for a break here. A breach, that's your target on the upside. Very clear, 90.65 into 91.22. A downside break, 200 week, or this is the 52 week moving average would be your first target, somewhere near 86.12, excuse me. And then the lower parallel for the current channel that we're in. So the levels are pretty clean. I was favoring a downside break of this near term before correcting higher. And the Aussie yen on the daily chart looked like this, right? You had really nice moves, very slight divergence. Again, always looking at this from a line chart, price action making a higher high, the oscillator failing to make a new extreme. Looked to me that we were looking lower. Well, we got the initial downside break and it came into monthly open support last week before reversing back higher. So the target was right here. Again, this market has just been very frustrating because it's just been, the moves have been so short-lived, and even though it's going well, they shake out right before, the technical levels that we're targeting. So 87.27 into that 200-day moving average, that's 87.33. We bottomed out, basically it was a low. 87.46, give me a break. This thing, here's what the intraday chart looked like. We actually caught this median line formation pretty early on, right? Even if you go to, well, this is the 24th. There's an update that we made prior to that. Yeah, here's what it looked like on the 28th, guys, to open the week, right? But if you look on the update from the 24th, we caught this median line pretty early on. And we said, look, if this is in play, any rally should be capped by that upper median line parallel. And in fact, that's already happened twice. You got a rally late on Friday, which failed right ahead of it. The weekly open is right here. We rallied to start the week. We failed right ahead of it. And then we were looking for that break below 87.70, and we were looking for a target 87.27. So we got the break, and again, turning right ahead of the lows, just the way the market goes sometimes. So it's very frustrating for me as a near-term trader, as that we are basically unchanged on the week. Despite the fact that we were right on the direction, there's just no follow through. So look, I'm still working under the same assumption. I don't really like that momentum is broadly holding 40 here as support. Again, a gun to my head, I still think it's prudent to stay bearish below 88.40, eventually looking for that tag of 87.27, and And more importantly, at this point, the 50% comes in at 86.72. So I don't want to be stubborn. If you're not already in this, if you see a decent trigger in near-term price action on an advanced higher with a stop against the only stop I would take, guys, that's comfortable in this, by the way, is against this high right here in Aussie yen, the Friday high. That was the initial position here. We're stop against Friday's high. If we plowed through, we're done. But now that we're right back at the weekly open again, I kind of want to see this hold and see that drop near 87.28. So stay with bearish invalidation at 88.40. That would necessitate a break of not only the weekly opening range highs, but also slope resistance. And if that level gives out, sayonara, you're probably going to see an 89 clip right back again. All right. Any questions here on Aussie yen? See if we still can't get that push lower. Again, this was last week's low, but it was also slope resistance. You see that one touch, two touch, three touch, fourth touch, saw acceleration, turned right ahead. Could be a false break scenario, but we want to see a settle below 87.70 here. Anything yen seems to be ping pong. Euro yen changing around too, says Pooja. Yeah, it's all the yen crosses. Was someone in the Daily Effects webinar here yesterday, guys, from one of you guys asking about pound yen? I just wanted to, we briefly just touched on this yesterday, and I just wanted to show that 151.94 target. It literally was almost about the low. The low is 151.97. So we were talking about this for someone in the webinar about the fact that, if this thing continues to drop, basically, it's going to be a rough time. Here's what pound Aussie looks like sort of on the longer term, and why I'm not really happy with it. We've kind of lost efficacy with this slope, and I've been working with just basic slope support off the lows. Touch here, touch here, touch here. This is your monthly open support. So, yeah, you're absolutely right, Pooja. Everything yen is just, and I think part of that also seems to be that we're getting some sort of scare in the broader risk markets. You saw that, again, this is the first time that we're seeing a pretty sizable pullback of magnitude this year in the SPX. Here's what the SPX looks like. Yesterday was the first, really one of the largest session losses to start off the year. Since the start of the year is the biggest loss. And even looking at it from a near-term price action. Well, first of all, let me highlight here on the daily chart, guys, for the S&P. At the end of the day here, momentum is starting to break into oversold territory again. And the break below into oversold territory from overbought into below that level, if we close here on a daily basis, would be suggestive that the momentum profile fits some sort of near-term correction. Now, get this deeper into an intraday chart on SPX, and you can see that, even a near-term channel just from the start of the year, here's your monthly open, your December 29th lows, one touch, two touch, three touch confirms. We got another two touches last week. We just broke that. Okay, so on its face, there's another slope that we were working with here. Once the upper parallel broke as resistance, it offered perfect support. That level comes in right around here, these former swing highs, and that basically gives you 2807. Another 20 some odd points in the S&P. That's just using basic slope, guys. Nothing else. Now you can start to dress this up a little bit. If you just take a retracement of the yearly range, for example. Let's see if anything interesting comes up. Yeah, 2800 comes up here, 2750 comes up here. I don't think this is going to be the end all, guys. I just think that you are definitely, as far as near section, the risk is lower. And again, don't take my word for it. We just broke below channel support. It's just try to keep things as basic as possible, right? As objective as possible. So you know what? Let's take a quick runway here, and let's take your questions before we wrap up the session. So Who wanted to take a look at Swissy? Was that you? E-Man wanted to take a look at Swissy, right? Let's see what Swissy's doing. Ah, I remember why I didn't write anything on Swissy. I have no downside targets beyond here. Here's what I'm looking at. So the daily chart, you guys know that we were looking lower specifically once this thing broke 95.50, sayonara. The levels was 94.86. The final level that we had as target was 94.38, and then the lower parallel. And this is just a basic trendline support off the 2011 lows. As basic as you can get. So it's only a 2-point touch. So it's something you're going to go crazy about. But we've since now broken below that, right? So where do we go from here is the question. That retracement's null and void. Okay. One concern I would just point out to you right off the bat, Eman, is looking at this on the daily chart. You've now made an outside daily reversal lower, okay, at the lows. I always tell you these things, guys, and it's just worth, it's not always going to be 100%, but things to pay attention to. This kind of candle at the highs, okay, or on a stretch higher, like right here, screams exhaustion, just screams it. Markets went into a new high. We tried to make a high. We failed. We did an outside reversal candle of the previous session. So this day's range covered the previous day's range. That's bearish. But when you get that kind of development at the lows, sometimes this can be an exhaustion trade, right? Markets try to push lower, and specifically the fact that they push even lower, we can't quite make the low. If we were to close at these levels, I'd be concerned for some near-term recovery here in dollar Swiss. That said, I don't really have structure beyond here, E-Man. Let's see what the weekly chart looks like. And this is why it's always good to have a weekly chart. So if we do have some structure here, and it would suggest that we want to stay on a bearish path, basically below 94.72. So even if we were to get some sort of sizable recovery on a weekly basis, you have the 2016 lows, you have the closed lows for 2017, you have Fibonacci extension there, the 618, former slope support, we talked about that, and current median line for the downslope. All that looks pretty good. A break further down from here, longer term, you're looking at basically 90.90 into 91.20. Hey man, feel free to take a picture of this chart. This is the only thing I pay attention to. This is the weekly chart for dollar Swiss at this point. Now we can kind of just mirror this slope onto the daily here. Again, the 50 line catching support, catching support, catching support. Okay, let's clean this up, shall we? Okay, see if we can't get any pivots off this. One, two, three, four. Okay. Yeah, even if this thing rebounds, I still think you want to stay bearish below 94.86. It's that simple. It's that simple. Can I advocate to short from down here, Eman? No. can I advocate to try to fight this, even though this could be an exhaustion candle? No, because you're still in oversold condition. That means the market still has the push. So, man, there's nothing for me here imminent. Like, this is like, do something here, right? There's nothing that's screaming out to me yet. So for me, this is going to be something that's back on the lookout. There's even divergence here on the intraday charts, right? Price action making a lower low on a close, a lower low on a close, a lower low on a close, continued divergence into those lows. So, if we get some sort of reset rebound near 94.86, near even 94.40, I'd start looking. That might be an opportunity to get back on the short side. But fresh shorts exposure from here, I don't have. And if we do break lower, I really need to really start looking at and mapping out some longer term targets, because the weekly chart doesn't have anything till 91. And that's almost 118 pips. What am I saying? It's almost 218 pips from where we are right now, right? So I'd say broader trend is still lower. Near term, you're testing slope support. You're testing that 50 line. Could be a little bit of a rebound. Ultimately, if we do get something on a move higher, I'd look to fade that strength below resistance, below that median line, looking for a downside break ultimately to get us 91. E-man, makes sense for Swissy? Let me know if you're actually holding anything on that. I can give you a little bit more color on it. But she says yes. All right. And who wanted the DAX? Who is that for Pete? Pete, let's take it on. I haven't looked at the DAX in quite some time, but no reason not to. Let's see. Not bad. Does a 50 line catch anything there? Sure. Okay. Decent pivot on the lower 50 line. Decent pivot off the upper 50 line. Momentum profile. This is the weekly chart of the DAX, by the way, Pete. So reversal off the highs there. Close high for last year looks like. Okay, looks like that's your close high. And then your high day close. This is 2018. So the high day or the high week close would be here. Look at that. And here's your yearly open. So you broke, ever since you broke the yearly open, you've been stuck between the high close for the year, which is 13,480, and the high day, or the high for the year, the high close, and the high week reversal close. And that's 13,127. That's basically been the range essentially since earlier in the month. Interesting stuff here. All right, let's jump into a daily chart. Basic slope support, taken off the high from 2007, caught the high that we made in 2015. That comes in just higher. What's this? Let's scratch that for now. Highlight that as resistance near term. Key support is very clear on this one, at least. It's still going to be 12,740. Look, you have monthly opening range lows is literally there. Look at the wick for the open of the year. So the monthly and yearly opening range low coincides on the 200-day moving average, coincides on slope, And that's all right around 12,740. That's a very important level to keep in mind. Monthly open, yearly open support also comes in at 12,867. So 2 levels to keep in mind. It does look a little tired, but I wouldn't be playing an aggressive short stance just yet until you break at least the former swing low. So like 13,130, 140, let's call it. If we were to break below that, I think you can work with a structure. We'd start to look for some structure for the decline. And this is just to be correctionary, by the way, guys. Nothing here that suggests like a major high is in place yet or anything like that. But, oh, look at that. So you look to stay basically near-term resistance up into the upper parallel. Immediate support on this drop. Hey, come on. Immediate support on this drop. You have the 100-day moving average converging on the median line. That's somewhere around 13,050. Yeah. So here's the daily chart, Peter. That'd be sort of my interpretation, at least near term. If we break higher, you look for that slope confluence, like I said, a little bit higher, near 13,760. But as it stands right now, based on just the way that the advance is coming through in the momentum signature, if we do break below this region, I would be looking for a larger correction. Let's look even near term. Yeah, November highs actually ends up being right on the median line. Those are reaction levels that you want to pay attention to, Peter, on the DAX. My humble opinion. Again, this is just really quick on the fly for near-term price. That's what I'd be looking at. I'd be looking for either a drop into here for a little bit more of a concerted bounce, or if this is just correctionary, you get the rip higher, you'd need to see price fail ahead of 13,530, basically, to suggest that we are still in this correctionary pattern lower. Too early to tell. Every time the market's turned over, people start screaming and saying, this is the correction, this is the correction. So I'm not going to start jumping on that just yet. But certainly when and where it turned, I think does suggest that you want to be paying attention, at least for the possibility of another near-term exhaustion trade. All right, Peter. Guys, I'll wrap it up there. I'm way over on time. He says, clear, thanks. Say you got it. More than welcome. My pleasure. I will see you guys tomorrow morning. Same time, same channel. Hopefully, listen, let me take a step back. If you're holding anything into tonight's State of the Union address, just make sure that you open up your stops a little bit and lower your leverage a little bit on the position if you're already in the money. If you're out of the money, you make sure you're managing your risk. Okay, but it's not a high likelihood. Just doing this from so long, for so many years, State of the Union addresses aren't typically going to be like the major volatility factor. But in this case, with the Trump administration, not everything really is. We're in pretty much unprecedented territory every single announcement. So just keep that in mind. Again, 9 o'clock. If your heavy exposure is specifically on the dollar crosses, just make sure you're attentive to what's going on. We'll be going through again tomorrow the aftermath and give you a nice little update for what you'll be expecting heading into the FOMC tomorrow. Again, afternoon at 2 o'clock is when we get that announcement, with non-farm payrolls still looming on Friday. So it's going to be an interesting week. Best of luck trading, guys, and I'll see you tomorrow. Cheers.